Our next guest is Dan Friedberg. He's with Fenwick & West, it's a law firm. He has a background that has helped with banks and financial institutions for a long time, mostly around the compliance side of things. It's just one of the areas that they work in. Money transmission licensing, adhering to the Bank Secrecy Act, right? Banking has become de facto regulators for a lot of reasons, mostly around the banking, the BSA. So what we've seen is that there's a huge need in this industry for compliance-related issues to help protect with consumer protection. Their law firm also does everything else that you could think of when you are thinking about a fintech company. You need some, especially in the crypto space, you need someone to help you walk through your project to make sure it fits into the buckets that you think it should. And then they help with all the other legal aspects as well. So definitely someone that you should have on your side if you're looking to start a business in the crypto space, or you need some advice about where your business is going and how you should position it. So please welcome Dan Friedberg to the stage from Fenwick & West. Thank you so much. There's a clicker on me.
Perfect. Hi, everyone. Pleasure to be here, and now the lawyer is going to put you to sleep after all that energy. But I'd like to, just say a little bit about our firm, Fenwick. So we're headquartered here in Mountain View, and we pride ourselves on representing disruptive companies. I work in our payments group, and we've done a lot of work in the blockchain from the early days. So I found out about Bitcoin probably about 4 or 5 months after the white paper was released. Why I'm still working, that's another story. But I actually represented the most active company on the blockchain at that time, and there was concerns about whether Bitcoin was totally illegal. So I really wasn't in a position to buy coin at that time because it would have been a conflict. But anyway, so after the white paper was released, as I said, there was real concern as to whether Bitcoin was totally illegal. And that was for a few reasons. First, there's a law which states the US Mint is the only agency that can print currency. And second, there's this division of the Department of Treasury called FinCEN that regulates virtual currency. And there were concerns about how Bitcoin fit into that scheme. We had about 3 years of gray, and some very smart people formed the Bitcoin Foundation right in my home place of Seattle, and I worked with them in those early days. And that's how we financed the developers of the Bitcoin protocol. So, Bitcoin didn't have an ICO, of course. There were early miners that obtained the Bitcoin that was used to pay for the development. But through that Bitcoin Foundation, that's a model that we continue to use today with ICOs. And one thing that Satoshi would be very disappointed about is this huge rise of intermediaries that we've seen in the virtual currency space. So the purpose of Bitcoin was to be a peer-to-peer payment mechanism which eliminated intermediaries. And the reason for that is every bank from all time has failed. That's what happens to banks. And due to our regulatory regime, mainly, we've seen this rise of intermediaries, especially in our country, particularly with exchanges. And this would really bother Satoshi, I think, or does bother Satoshi. So anyway, I wanted to talk so most of this talk is going to be focused on tokens and coins and ICOs, but we do know all the different aspects of this blockchain industry. As most of you guys know, and this is just sort of taxonomy, when I refer to coins, that's going to be a native protocol like Bitcoin or like Ethereum versus a token which is floated on an existing protocol and entitles the holder to some contract rights. Most of the ICOs that we're seeing these days are with tokens. They're distributed in a bunch of different times. The traditional method, Bitcoin, was that it was distributed through mining. Some new protocols are done that way. It's a very safe way to do it in the regulatory scheme. Others sell, before creation of the token, at the time of the token being issued, and some actually sort of gift or give out tokens to the general public. All of these types of distributions are regulated in the US and require compliance. And there are various timings of the sales, and that impacts the regulatory regime as well, whether or not the token's being sold before, when it's just a dream, when it's just a white paper and a future token, or later on when the protocol is functional. So I wanted to sort of talk about what I consider maybe the four legs of the chair. And this is, we're looking at the United States. So at Fenwick, we do focus on these internationally, and many of our issuers have chosen to avoid the United States. But those that touch the United States should be conscious of these four different areas. And although there have been a lot of press releases and statements lately, and you've seen a lot in the media about the changing laws, we don't see any real changes in the past 6 months, certainly. All these laws have been in place since the beginnings. These ICOs we've only been working on for about 18 months or so, but all of these laws have been in place since the beginning, and there's no changes to the law. And we've just heard a little bit of noise, and if you go back over the history of cryptocurrency, this is just a small amount of noise. We're going to be seeing much more regulation in the future. And I know that the markets and people in the press say that the price of virtual currency has been volatile lately. And obviously, those who follow virtual currency know that's not the case. I mean, it has been incredibly stable. I mean, people who go back remember times where the price of Bitcoin went up 10 times in 3 days. And now people are commenting that a 50% drop is some major event. But obviously, it's nothing if you look at the history of coin itself. And we're going to see continued volatility. But so all four of these areas you should be conscious of, regardless of your business in the blockchain space, to see if they impact you. And the first is the one that we've been hearing a lot about recently, which is the SEC. And this is no surprise. This is actually probably the clearest and most established area. The law that's cited actually goes way back to the 70s and 80s, the case law, and even earlier. So the securities is there's nothing new. And basically, the issue is if a token or a coin constitutes a security under the common law test, then you have to comply with US securities laws. And that's no surprise. I think that there'll be continued enforcement in this area. Somehow the industry got off the rails, in the past couple, just when these token things started. And, I really actually kind of embarrassed of the bar, the way the lawyers treated it, because some of the largest firms in the space sort of let these tokens slip through without complying with securities laws. And it generally is not the fault of the companies who want to comply. There are regimes in place that you can follow to do a proper token offering, but you just need to comply with securities laws if there's a good chance that your token constitutes a security. And at Fenwick, we've always done all of our token and coin offerings as if they're a security, just so that the client has a safe harbor, just in case the SEC looks at them. The second major area, which is still amazingly being totally ignored by a lot of companies, is the Department of Treasury. So the Department of Treasury, a division of it is called FinCEN, the Financial Crimes Enforcement Network. It's sort of similar to the FBI. It's a division of the Department of Treasury. And they're charged with regulating virtual currency. And it was actually with FinCEN, as I said before, that we had the biggest concerns when Bitcoin was first issued, that Bitcoin was entirely illegal. And I remember those calls to FinCEN where I asked if Bitcoin was illegal, and of course their question is what in the world is Bitcoin? And that lasted for years. But then about 3 years after the white paper was released, they did provide an explanation that there's a type of virtual currency called the decentralized virtual currency. And if your virtual currency is decentralized, you're not required to register with FinCEN. Accordingly, it's most of the tokens that are compliant are organized in a manner in which the token is decentralized. But there are many, many out there where companies directly issue coins and tokens, and that's obviously going to create a problem under FinCEN. FinCEN believes that if you're an administrator of a coin or token, and that means if you have the power to issue and redeem the token, and that token is convertible into cash or Bitcoin or Ether or a cash equivalent like that, then you need to register with FinCEN and actually track your token holders. So that's the reason that many, many companies have their tokens issued by an independent nonprofit or foundation, because they're trying to follow the Bitcoin model. Somehow, though, this is an area which completely got off the rails, and you just see private companies, directly issuing their own coin. Obviously, when they push the protocol, they have the power to issue and redeem that coin, so they should technically register with FinCEN. And we've seen, now FinCEN's very slow to move, but we'll see more regulatory enforcement. And FinCEN is just about the most serious regulatory authority that you have to deal with, because these are actually financial crimes that we're dealing with. And when they knock on your door, they carry guns and they are ready to arrest. So FinCEN's a tough one. There's a state corollary, which is all the states other than about 3 have regulate money transmitters. And it's very similar. The reasons are different, though. On the state level, it's more based on consumer protection rather than national security. So that's another area of compliance. The penalties generally are far less severe, though. In most states, if you have a problem, you can simply negotiate to exit the state. So it's not nearly as serious. Another area is the commodities, so the CFTC. So as most people know, tokens and coins are generally commodities. Now, these definitions are not mutually exclusive, which is a crazy part of the US law. So you can have a coin that's a security, that's a virtual currency under FinCEN, and that's a commodity. So you have to comply with all the laws. It's not like it's one or the other. And there's a fair amount written that's incorrect on that says that if your coin is a virtual currency, it's not a security, and that's not true. Each of these agencies have different reasons and different rationale in applying their definitions, and you have to make sure to comply with each. And then the last is that many of these tokens are sold as future tokens, meaning that the token hasn't been built yet. There, you fall under the same rules that you would with Kickstarter, in that it's a pre-sale of a good that hasn't been created yet. So there need to be a whole bunch of consumer disclosures that apply, because there are risks in buying a token that hasn't yet been built. If you're conscious of all 4 of these, you've hit the major areas in the US on regulation. Here's something that's interesting, and there's confusion here as well. So we represent a lot of the largest gaming companies in the world, like Tencent and Niantic, which made Pokemon Go, and all those companies have what we call in-game currency. And that's a currency that is not convertible into cash. And so that's what we would call closed or centralized currency. And that is actually quite easy to work with because the governments don't have really concerns about that. Typically, these coins are just used within the game, essentially as a license to an in-game feature or an in-game gameplay. And those don't require registration. They do require specific terms and some provisions in the event that the game company fails. But those are quite easy to deal with compared to these open loop currencies or these decentralized currencies that are convertible into cash. And now most tokens, as you guys know, aren't really directly convertible into cash. Instead, they're designed to be converted into Ether or Bitcoin or another convertible currency. As far as the government is concerned, that's the same as being converted into cash. So in our world, in the blockchain world, most of these tokens are decentralized. So we are, I wanted to talk to you guys briefly about the sort of the attributes of a great token offering. And we've lost this a bit in that there's sort of a frenzy in the market to buy anything. But the best tokens will somehow take advantage of the blockchain in a specific way so that it makes sense that this is a token. And that's actually important for the legal analysis as well. If the token is really floated simply as a means to raise capital, you're much more likely to be deemed a security. So the best offerings are those that somehow take advantage of the unique attributes of the blockchain. And the second piece that we always look at is that the token shouldn't just be replaceable by an existing cryptocurrency. If the token all the uses of the token could be satisfied by Litecoin, for example, why are you creating your own currency? So the best token offerings have a reason that their token is different than the existing protocols or tokens that are out there. The third is our standard look, is at team and management, and that's the most important attribute of any company. And we like to only represent clients that have multi-billion-dollar markets, and that the purpose for having a coin or token should be more than just capital raising. I'd like to talk to you a bit about our approach with these token offerings. And we actually are very conservative and much more conservative than most firms there, and have actually always been this way. And for that reason, our market is pretty small, actually. But on the security side, we do follow generally tokens attempt to avoid characterization as a security. And I know that there have been statements from the SEC that sort of lead people to believe that's not possible. But it is possible in many instances. Let's first take a pure protocol example. So generally, the SEC agrees that Bitcoin is not a security. Bitcoin is just simply invented as a means to transfer value. Okay? And if it's just a means to transfer value, it doesn't fit the common law definition of a security. So you can pretty much get people at the SEC to say, oh, yes, Bitcoin's not a security. So then I say to them, I say, oh, I have this client that's copying Bitcoin. They're making a clone of Bitcoin. It's called Dan Coin. Is that a security? And then they start to mumble. They say, what do you mean they're copying it? Oh, all they're doing is copying the code. If Bitcoin's not a security, how can a copy of Bitcoin be a security? And they don't understand. And they don't get it. But the answer is that a pure protocol in and of itself can't be a security because it doesn't fit the common law test. Now, with respect to tokens, so that's more than just a pure protocol. A token has some sort of contract right or some features that are in addition to the pure protocol play. And there, the common law test has to be applied to see if it's a coin, or pardon me, to see if it's a security. We've sort of been disappointed because the SEC has just come out with, general statements saying that something's most likely a security if the protocol hasn't been built yet. Well, come on, we as lawyers know that there's Kickstarter. You can buy a good on Kickstarter that hasn't been built yet. If you buy a Pebble watch on Kickstarter that hasn't been built, is that a security? Of course not. Okay, so what if you buy a token that entitles you to the Pebble watch? That somehow is a security? So these are questions that haven't been answered yet, but the place to start is with the common law test. And it would help everybody in the industry if instead of the SEC making broad statements that tokens are generally securities, apply the Howey test. Explain when the thing is a security and when it's not. And the problem is, and the reason they don't, is because most of these tokens fail the Howey test and aren't a security. And that's going to be tested ultimately through the courts. But right now we're in a situation where the SEC is sort of taking this strong view because they view this as an area that's subject to abuse, and they're right. There are a lot of bad actors out there. So the safe thing to do is to accept the fact that the SEC is most likely going to view your token or coin as a security, and to follow all the securities laws that apply with respect to that instrument. So upon the sale, you actually treat it as a security without admitting it is such. So that's on the security side. On the tax, this is an interesting area because a lot of companies, when they come to see us, and so they raise $50 million in a future token sale. Their next question is, do we have to pay tax on it? And so there's all sorts of companies out there and accountants who have invented creative ways to avoid U.S. taxation on those proceeds. So in some cases they work, but they generally only work if it's a true foreign issuer. That is, that if it's not connected to a U.S. founder or a U.S. company. This is not a place to be aggressive. My experience in the space has been that once my client gets through the SEC successfully, magically he's audited by the IRS. That's sort of how the regulatory authorities work. And if you have a successful offering, you're going to be scrutinized. So this is not a place to do aggressive tax structuring. Usually, future token interests sold are a pre-sale of a good, so they will constitute revenue and often are attributed to the US. So this is just a place to be careful. The FinCEN we've talked about a bit. So our approach there generally is to determine whether or not it's centralized or decentralized. And if it is centralized, then the answer is to register with FinCEN or to conduct all sales through an intermediary that's appropriately registered. Similar to the securities analysis, we recommend that our clients comply with the rules of FinCEN, even if they don't think that it is applicable to them. So in the offerings, the safest course is to follow all the same procedures as if you were registered with FinCEN. And basically, none of our clients want to engage in money laundering. First of all, money laundering, I know that that's FinCEN's primary concern. Money laundering, it's just sort of a stupid concept in these ICOs or in these future token offerings. The reason is because people are exchanging a perfectly anonymous form of currency, such as Bitcoin or Ether or whatever is accepted, into one of these tokens, which is not as liquid, which has identifying information attached to you. You're going from an anonymous currency to one that's actually not anonymous. So it's a terrible way to launder money. So it's not, for someone to take their perfectly anonymous Bitcoin and buy into one of these token offerings is the opposite of money laundering. It's placing their identity on a token. Then the last piece that our approach with the consumer disclosures is to treat these tokens typically as a pre-sale of a good. And therefore, you need that whole list of disclosures as if it were a good on Kickstarter. The current concern there is that some issuers won't deliver the token, or they may not deliver the token in accordance with its specs. So the consumers need to be advised of their rights of that situation. And we're going to see more and more states look at this as a piece, because this is something that's pretty much ignored in the typical future token instrument that you see, that's just circulated online. So overall, and this is just with a token offering, these occur pretty quickly. The demand right now is much more discerning than it was a few months ago, but it is still there for the good offerings. We see a tremendous amount of demand from Asia right now. We also continue to see great demand from people who hold appreciated crypto. There are also specialist funds that are buying into these that have continued demand. We represent a lot of traditional VCs at Fenwick, and they are just slowly tiptoeing in the water. It's actually only in the last 2 or 3 months that I've really begun to have a lot of meetings with them to talk about crypto. So your typical VCs are probably still, 6 months or a year out before they get into these in earnest. It doesn't really fit with the normal VC model of valuation and so forth, but there is beginning to be this fear of missing out on these opportunities. Also, a discerning person who truly believes in crypto would note that the blockchain offers the ability to disintermediate venture capitalists. That is that, if you look at Satoshi's true dream, it was that, individuals through the blockchain could invest in whatever they wanted without a big intermediary. And so that could actually be a threat to venture capitalists. Now, all our security laws are designed to prevent that. We have these laws that basically say, hey, you have to be worth $1 million to buy into most offerings. To me, that's just so unfair that we are restricting all our best offerings to the rich. But that's something that's going to take more time to change. But the dream of the blockchain, of course, was that anybody could invest in a company. And actually, when these token offerings just started, the typical way to do it was that people would send around an email with an Ether address, and people would just buy in. And that was typical for me to get a call saying, I have $30 million in Ether that I sent around this email. And no identifying information, no idea who the person was other than their Ether address. And that's how ICOs started. And actually, it sounds crazy, but it was really democratized. It was fair. Anybody could participate. It's our US regime that sort of prevents that, but there's still a way to achieve the dream, and just have to comply with regulations, and it's expensive, but there is a way to do it. But this whole process does take some time. It usually takes about 3 or 4 months. And it's best to get advisors in initially with the token design, because if the token isn't designed properly, sometimes it will create problems on the regulatory side as well as the business side. And then there's generally a corporate structuring process, and a piece in which is a very difficult piece, is actually to get the initial tokens to the founders and the companies. I know that in some of actually the biggest offerings out there, they failed to get tokens to the advisors, but they started to raise money on future token interests. And due to tax rules, you can't get the tokens to the people anymore, because the tokens are worth $100 million. How are you going to get $100 million worth of tokens to a founder located in the US? How is he going to pay the taxes on that? So you sort of have to keep in context the whole tax regime when you do the process. And actually, part of it is generally getting a valuation at the time that you do any of those early issuances. So there's a bit of a headache up front, and it does delay things, but it's way better than our issuers that come to us and having already raised, and then they look at the white paper and say, look, our team's entitled to 10% of the tokens, and then you do the math and you realize that's $100 million. There's no way that you can get the tokens to them in the way they wanted, because the tokens have appreciated in value in that time. Anyway, and here's something to note which is interesting. That last step there, the public sale, that's sort of a dying thing, at least in the States. And that's because it's very difficult to do that in a qualified manner in the States, due to the position that's generally taken that the tokens might be securities. So what we've seen with our biggest offerings, actually, is that the entire offering is generally filled in the pre-sale stages, or what we call the future token interest stage. And that's done in a qualified offering. And oftentimes the public sale is avoided at all, or is done outside the US, or is just done as a small airdrop. So I just wanted to circle back to the initial topic, is that so having seen this space evolve, we are just at the very beginnings here of something that's amazing and revolutionary. We are going to see a time where most of these tokens out there fail that are currently existing. However, there will be some that emerge that will likely be larger than any company that we have. And we believe in that. And can blockchain be bigger than Apple? Of course, blockchain is bigger than Apple. Can a particular coin in blockchain, like Bitcoin, be bigger than Apple? I think so. I mean, if you look at the fiat currencies out there, do you guys know what the longest lived fiat currency ever in the whole history of the world has been? It's the British pound. So the British pound is the longest lived currency ever. I think we're headed to see the end of that British pound. in our lifetimes. And it's going to be replaced by something new. The US prints more money each year than the value of Bitcoin. People think Bitcoin's worth a lot. The US just prints money. And basically the demise of the US currency happened when Nixon took the currency off the gold standard in the 70s. So there was a time when every dollar of ours was backed by a dollar's worth of gold in Fort Knox. Then we got into Vietnam and started spending money like crazy, and we ran out of gold. So we just took the dollars off the gold standard. It's the same thing the Romans did. If you look at Romans coins, they can date coins by how much of the gold has been shaved off by the government. So initially, the coin actually was made of gold. Then the Romans ran out of money, so the mint scraped the coins down to nothing and then would fill it in with a cheap metal. And so basically, you begin to see the demise of all currencies when they're taken off a standard, and we've seen that with the US already. So I am a big believer overall, but we're going to have a lot of shakeup. And so where are we now? So those people who want to do an offering here in the chain, on the blockchain, it's critical to work within the regulations because we are going to see a lot more scrutiny. Pick projects that harness the unique power of the blockchain. And then, of course, recognize that all intermediaries, whether they're exchanges or banks, ultimately will fail. And it'll be a peer-to-peer mechanism that persists. So that's about it. And I don't know if there are any questions or if I'm at the end, or I'm also happy to take questions after, too. Okay, perfect. I've run out of time, but thanks so much.